In December 2018, something happened that was not supposed to happen. Markets were sliding, liquidity was thinning, and investors watched, stunned, as the final month of the year, the month that historically brought calm, stability, and even holiday cheer, became the single worst performing month of the entire calendar. By Christmas Eve, the S&P 500 had fallen nearly 10% in 3 weeks. The Federal Reserve, faced with slowing data and deteriorating sentiment, chose not to cut rates. And for the first time in nearly 70 years, December broke one of the most consistent patterns in financial history. If you zoom out far enough, December is one of the most stable months in the entire stock market. But in 2018, that pattern reversed, and it reversed sharply. And that moment forces a bigger question. Why does December so often behave differently from every other month? And what actually drives the strength that shows up in decade after decade of market data? To answer that, we have to step back from 2018 and understand the real forces at work. Forces that have shaped markets since the 1950s and still shape them today. Because December's behavior is not magic. It is not luck. It is not a holiday myth investors tell themselves. It is structure, incentives, and a system built around reporting, taxes, momentum, and policy cycles that converge at the same moment every single year. Once you see those forces clearly, December stops looking like a superstition and starts looking like a mechanism. It's the middle of December, and once again people are wondering whether the market can keep climbing. The S&P 500 has been strong for most of the year, rising 7 months in a row, an extremely rare streak in market history. Inflation has eased slightly, just enough to give the Federal Reserve room to cut rates again, and seasonality data, the historical performance of markets by month, shows December rising more than 70% of the time. But here is the thing, seasonality does not predict the future. Patterns do not guarantee outcomes. And if you are only looking at charts and averages, you are missing the deeper machinery underneath. December's reputation comes from structure, not superstition. So let's unpack that structure, piece by piece, and reveal the 4 forces that actually drive December's behavior. The first thing to understand is the scale of the pattern itself. Since 1950, December has been the 3rd best month of the year on average. It also has the highest probability of posting a positive return, higher than January, higher than April, higher than all of them. It rarely collapses, rarely spikes out of control, and almost never shows extreme volatility. It is, in a word, stable. And stability is not a natural feature of markets. Something has to cause it. This is where incentives enter the picture. Every December, trillions of dollars are repositioned because the financial system demands it. Not by decree, not by conspiracy, but by simple mechanics. Portfolio reporting, tax calendars, liquidity cycles, and institutional pressure. The first mechanism is something most individual investors never think about: window dressing. If you run a large fund, your year-end report will be sent to clients in January. Those clients will see what you owned on December 31st. No manager wants to explain why they held a stock that collapsed. No manager wants to show a portfolio filled with losers. And every manager wants to appear aligned with the strongest trends of the year. So, throughout December, institutions dump underperformers and add outperformers, sometimes even if the fundamentals do not change at all. Those flows push strong stocks slightly stronger. They raise the base level of demand. And they create a mechanical tailwind that feeds into the month's stability. We saw this clearly in the mid-1980s. Between 1985 and 1986, global currency markets were still adjusting from the Plaza Accord, a coordinated attempt by major economies to weaken the United States dollar. Volatility spiked across international markets, but December remained unusually stable. Why? Because fund managers were aggressively rebalancing into the winners of that year: technology, industrials, and emerging multinational firms. At the same time, they were quietly exiting the sectors that had struggled under the currency shifts. The pattern repeated in 1991 and 1995, 2 years where broad markets surged into year-end, despite geopolitical uncertainty. Window dressing did not create a rally out of nowhere, but it reinforced one that was already underway. The second mechanism is tax loss harvesting. In the United States, investors can sell losing positions to offset capital gains. Most of that selling happens in November, when funds are finalizing their tax strategies. When those positions are sold, investors often buy them back roughly 30 days later, which usually means late December or early January. This creates a brief period of selling pressure, followed by a burst of buybacks. That is one reason the so-called January effect, originally identified in academic studies from the early 1960s, actually starts in late December. The third mechanism is central bank policy. December sits on top of the Federal Reserve's most important communication window, the final meeting of the year. Markets spend all of December interpreting, digesting, and repositioning around whatever message the Fed delivers. When the Fed is easing, or even hinting at easing, December tends to be strong. When the Fed is tightening, or refusing to ease despite mounting pressure, December becomes fragile. We saw this in 1998, after the collapse of long-term capital management. The Fed cut rates multiple times in rapid succession to stabilize markets. The result was a powerful year-end rally, not because investors felt euphoric, but because liquidity was being restored and risk-taking was being encouraged. We saw a softer version of this in 2001, when the Fed cut rates aggressively after the September attacks. Markets were still volatile, but December showed resilience because policy was moving with the data. And then there was 2008, which flipped the pattern entirely. Despite massive cuts, the underlying financial system was too damaged for seasonal forces to matter. December was not the worst month. September and October took that prize. But it showed that even the strongest seasonality can be overpowered when the structural integrity of the system is compromised. And of course, we saw the most vivid example in December 2018. This is where the fourth mechanism shows itself clearly. Momentum persistence. When the first 10 months of a year are strong, the final 2 months tend to follow. It is not optimism. It is not simple bullishness. It is mechanical inertia. Trends take time to reverse. There have been 16 major streak years since the 1950s, years where the S&P 500 gained more than 10% heading into November. In those 16 cases, December finished higher 10 times. And when you extend the window out a few months, the win rate becomes even more impressive. Historical streak years, like 1954 and 55, 1983, 96, 2013, and 14, all reflected the same underlying force. Trends last longer than people expect, because the system behind them changes slowly. So, when you combine these four mechanisms, window dressing, tax loss harvesting, policy pivots, and momentum, December starts to look less like a lucky month and more like a structural phenomenon. But understanding the pattern means understanding when it fails. That brings us back to December 2018. For most of that year, markets had been volatile but functional. Growth was slowing but not collapsing. Inflation was stable. The economy was not overheating, it was cooling. Normally, this is when the Federal Reserve pauses or eases. But in December 2018, the Fed raised rates. Not only that, officials signaled more hikes in the coming year. The market interpreted this as a policy error, tightening into weakness. And because December is structurally dependent on stability, the moment volatility surged, the pattern broke. Selling accelerated, liquidity thinned, and a month that had spent 70 years as one of the safest on the calendar became the single worst month of that year. It was not a mystery. It was not randomness. It was not the market ignoring seasonality. It was structure. A key pillar, policy alignment, moved against the other three, and the pattern snapped. This matters today not because 2025 is destined to repeat any of these years, but because the underlying incentives remain the same. The Federal Reserve is once again in an easing phase as inflation trends lower. Funds are entering December with substantial unrealized gains, setting the stage for tax strategies and momentum reinforcement. And the S&P 500 has quietly built a string of monthly gains that resembles past streak environments. None of this dictates an outcome, but it does reveal something important. December behaves the way it does because the system is designed that way. When incentives align, reporting cycles, tax calendars, liquidity flows, and monetary policy, December becomes calm. When incentives conflict, as in 2018, December becomes fragile. The point is not to forecast December. The point is to understand it. Because once you see how these forces interact, you understand something deeper. Markets are not random. They are structured. Patterns do not predict the future. They reveal the machinery. And December, more than any other month, exposes that machinery in plain sight. So the question becomes this: not, will December be strong this year? But which incentive is driving the system right now, and which ones are quietly reinforcing it from underneath? What do you think? Tell me in the comments what pattern you see emerging this December. This is Money Margins. Thanks for watching, and I will see you next time.